Welcome options traders, and in this video I just want to do kind of a quick recap of the Greeks that we talked about here for Greek week, and in particular the four key Greeks, delta, gamma, theta, vega. And so it's nice to do a little bit of a summary, but to see them all interact together. And the best way to do that is with a pricing model. And one of the easiest to use, one of my favorites, is from the CBOE, Chicago Board Options Exchange. If you're looking for this, the easiest way to find it is just go to Google, type in CBOE Options Calculator, and it'll take you straight to it. But one of the things I really like about this calculator, you can see that I can put in my own figures here. So if you're just practicing with your Greeks or trying to look at hypothetical situations, you can do that. However, I can come up here to this little blank box up here, and I can type in a ticker symbol. So let's say I put in IBM. Click on Go, and it will populate all of these boxes with the current stock price, the various strikes. I can click from all the different strikes in this drop-down menu. It'll show me the days to expiration, but most important of all is it will show me the current volatility of that option and the implied interest rate that's being used. If there are any dividends in IBM, it will show you those and the dividend dates. So obviously, as you change the different strikes or the time to expiration, it will start showing you different volatilities, different interest rates, and it will repopulate all of these boxes. So it's a wonderful tool if for some reason your broker's platform doesn't show you the implied volatilities, or you just find it easier to work with a pricing model. That's going to be important for going forward, because I'm going to show you when you're trying to look at option prices and trying to decide if a current options price is expensive or cheap, the only way to do that is with a pricing model. I believe I said that in some of the videos. You absolutely cannot say that an option at $3 or below is cheap and anything over is expensive, and yet that's how I hear a lot of traders talk. But you can't do it. Cheap is relative, and it all depends on volatility. So that'll be a topic for a future class, but I just want to let you know that this is a wonderful tool. You should get in there and start practicing with it. All right, so let's go back and reset this model. Just use some manual figures in here. So I'm going to make the stock price 100, the strike 100, time to expiration 90 days, zero interest rates, and I've chosen this kind of odd sounding volatility here at 25.26. And I did that to give us a nice round option value here of $5 for the call and $5 for the put. The first thing I want to point out, I mentioned in the Vega class, is to remember that time and volatility are two different ways of magnifying an option's price. I can either increase the time to expiration and get more potential option prices, calls and puts, and that would therefore increase the value of those options. But I can also do it by magnifying or increasing volatility. It's another way of magnifying the potential for those stock prices. But the degree to which those two variables move, time and volatility, is not the same. Volatility is proportional to the square root of time. So watch what happens. If I want to double this option's price right here, we'll just look at the calls. A couple of ways I can do it by keeping the stock price constant. One is I can double my volatility. So if I make this 50.52, let's say, and I choose calculate, then I should get an option price of almost 10. And there it is, 9.98. However, let's go back to 25.26, and I can get the same effect by changing time. However, I cannot double time because it's proportional to the square root of time. So if doubling volatility doubles my options price, I need to make the time to expiration increase fourfold to get the same effect. So watch this. I'm going to change this from 90 days to 360, increase it by a factor of 4, choose calculate, and I should still get that $10 option, and there it is. This will also help you to understand why increasing time has a similar effect as increasing volatility. And I'm mentioning that now because once we get into strategies and start picking apart strategies and what makes them tick and which ones are better in certain situations, you need to understand the way that these variables move and interact with each other. So that's an important one to know. Time and volatility generally move in the same direction, meaning if you increase time, it's the same thing, not to the same degree, but the same thing as increasing volatility. All right, let's bring this back to 90 And let's run through our Greeks here. I've got a call option price of $5, and I see that my delta is about 52.5. What does that mean? Remember, it's telling me that if the stock price makes a $1 move right now, that I'm going to add about 52.5 cents to my call price. So let's change this current stock price from 100 to 101, and my options price should move from $5 to about 5.53. So I click on 101, I choose calculate, and it's a little high. What happened? Why didn't it come out exactly? Well, hopefully you remember it's because of gamma. Gamma shows that our deltas are going to be changing as that stock price changes. And so therefore, moving from 100 to 101 is technically too big of a move. The better way to see that is to look at my delta as a percentage change in the underlying. So if we come back here to 100, and I see that my delta is 52.5, the better way to say that is that my options price is going to pick up about 52.5, let's call it 53% of the change in the stock. That's why most traders like to say it's for a $1 move in the stock, because then they can just say it changes by 52 cents. But in the real world, you'll find out that's not going to work out too well. It'll be close in most cases, but there are times you're going to want to know very specifically. So if you have a very big gamma position here, understand that your delta figures are going to get thrown a little bit. So if I want to really make use of this 52.5 delta, I need to stick with small changes in the stock. So let's make it go up by maybe 10 cents. 10 cents, if I pick up 52.5% of that, should be about 5.2 cents. So this options price should go to about 5.05, maybe a touch more, and now we see that it is. And technically speaking, even 10 cents is too big. But I'm just trying to show you this is why you have to be careful about your interpretation in delta. And you definitely have to be careful about saying, if my delta is 52, that it's always 52. That's not true. It's definitely going to be changing. You change any of these figures over here on the left, you will get new Greeks. Maybe not big changes, but you will definitely get changes. So let's reset this back to 100. And so hopefully that helps you to see what delta is going to show you. Increase the stock price by $1. This will be roughly what you're going to pick up in your options price. Now for puts, we have to remember that we get negative deltas. And the math gets a little tricky for people here, that if I increase the stock's price, I need to add this to my options price. So if I'm adding a negative number, I'm really subtracting it. So if I make this to 101, I'm going to lose about 48 cents on my put. So watch this. We go to 101, and we lose about 48 cents. Again, it's not exact because of gamma, but it's pretty close. Now also notice, we talked about in the delta class, that the delta of the call, 52.5, plus the delta of the put, ignoring the minus sign, adds up to 1. And that's because these are at least the approximate probability for the option to expire in the money. That's critically important once we get into strategies. And I'll show you some reasons why a little bit later in the video. But those two numbers will always add up to 1. Let's take a look at gamma. Gamma is 0.03. Gamma, of course, is measured in deltas. It's the exception to all of our Greeks. Delta, theta, vega, and even rho, which I didn't really talk about in the videos, they are all measured in dollars. And that means it's showing us by how much our options price will change for changes in these various factors. Gamma is the exception. This is measured in deltas. So what does that mean? If I increase my stock price by 1 right now, then I should get about a 3 delta increase. I should move from about 52.5 deltas to 55. Let's see if it's true. I make this 101, and again we get roughly 55.5. And I get a new gamma, new theta, new vega, new rho. So if the stock moves up another $1, I should pick up about another 3 deltas. I should go to about 58.7. Let's try it and see. And there's 58.7. So you can see what happens as the stock price continues to climb, my deltas start to climb, and my gammas start to fall. Because as the option gets deeper and deeper in the money, it is becoming more likely to be exercised into shares of stock, and therefore is going to behave like shares of stock. So for example, Let's just go ahead and rack this up here to maybe 150. And so, yes, you can see that my delta is now virtually 1, my gamma is virtually 0, and this is shares of stock. Look at this, we've only got 0.25 cents worth of extrinsic value out here. So this is stock. And this throws a lot of new traders, and they overlook a lot of invaluable strategies. This is a way of controlling a $150 stock for $50. You're getting 3-to-1 leverage, and you have no maintenance calls, you have no Reg T requirements, you have no interest charges. And this is shares of stocks. That's a little insight into a strategy we use called the stock replacement strategy. And of course, we don't have to go this deep in the money. We can still get a little better leverage, but still keep these deltas very, very high, which will necessarily make that gamma go very, very low. And so kind of a neat little strategy right there for anybody who's a stock investor and says, I don't want anything to do with options, I'm going to stick with stock. This is stock. It's just a very cheap version of stock, so why not use it? Get better diversification, better leverage, lots of wonderful qualities. Let's bring this back down to 101. What else could I do to increase this option's delta to 100? If I have an in-the-money option, which this is, got the stock at 101, I could also decrease time. This also throws new traders. They think that the only way you're going to get a delta 1 option is to buy it that way. Not true, it's going to change. Watch what happens if I change the time to expiration from 90 to 80 days. Watch the deltas. Increased a little bit. Let's knock it down to 30 days. Increasing some more. Let's knock it down to 10 days. Now we're at 60. Let's knock it down to 2 days. See, now we're at 70. Knock it down to 1 day. See, now we're starting to climb. And as we get closer to expiration, that delta will hit 1. Why? Because it's an in-the-money option. We all know the answer now. We know for sure that that's an in-the-money option. And if we know that, then its delta is 1. See, prior to expiration, we didn't know that. And so the market's trying to guess as to whether each strike is going to finish in the money or not. Let's reset this back to 90. What about Theta? We talked about Theta, said it was measured in dollars, and it shows us by how much our options price is going to decrease for 1 day's passage of time. Theta is always negative for a long option, one that you buy, and we see that it's about minus, let's call it 3 cents. So if I change my time to expiration from 90 to 89, this option's price should lose about 3 cents or be about 5.51. So watch what happens. We'll make this 89, and it's 5.51. And I get new delta, gamma, theta, vega. All of your Greeks change all of the time, even if for no other reason, just because time has changed. And that's important. A lot of times new traders are sitting in a strategy, especially when they can build up a big gamma position, some of these premium collection strategies, and they say, well, the stock's moving 50, 75 cents a day and nothing's happening to my position. And then they get to expiration and assume that same thing's going to happen. Stock makes a tiny move and they get a huge drop in price. And they're trying to figure out, well, what happened? Why was my options position so sensitive today and 6 weeks ago it wasn't? It's because of your gammas. Or it could be because your deltas are changing because the time to expiration is changing. So at a minimum, just understand that all of your Greeks change all of the time. Now finally, let's take a look at vega down here, about 19.7, roughly 20. It is also measured in dollars, and it tells us by how much our options price is going to change if volatility changes by 1 tick. So if I change volatility from 25.26 to 26.26, my options price should pick up about 20 cents. I should be trading for about 5.71. So let's change this to 26, and it's 5.71. So that's exactly how you want to use vega. Notice that vega is positive for calls and puts. Theta is negative for calls and puts. That's assuming we've purchased these options. Now let me mention very briefly rho. I said I wasn't going to make a video on it because it's just not real important to most options traders. And that's because it shows us the options sensitivity to changes in an interest rate. So let's come over here and make interest rates, let's say 2%. I'm going to change this back to 100. And so the first thing we see is that the increase in an interest rate increased my call option from 5 to about 544, and it decreased my put option. So you might think, well, interest rates have a very powerful effect. The problem is really twofold. First of all, interest rates, at least for the US, normally go up in quarter point moves. So we rarely get a full 1 percentage point move or a 1 tick move in the interest rates. Second of all, once the Fed announces or even hints that there's going to be an increase, it gets factored into the option prices immediately. So once the interest rate is actually announced or actually changed, it will probably have no effect on your option. Remember, markets are forward-looking. They're always trying to anticipate. So let's just go through an example here. Interest rates are 2%. Our row is 0.12 or 12 cents. That means if interest rates are increased to 3% right now, this options price is going to pick up about 12 cents and be trading for about 5.55. So let's make this 3, and there's 5.55. So once again, because they move in quarter point increments, we'd probably see this go to 2.25. So you might go from 5.43 to 5.46. You're only going to pick up about a quarter of this move here, about 3 cents. And that's why I said row, for the most part, just doesn't play a role. And that's why we don't put it on our platforms and really pay much attention to it. However, as I mentioned in those classes, if you're trading currency options and you're dealing with a country that has runaway inflation, row could easily be your biggest risk. So don't discount it and say it's a meaningless Greek. It's just that for most people trading equity options or options on stocks, it's just not going to play a part. So that's why we don't really pay attention to it. So this is a very good exercise to go through. Pull up the option pricing model, make up some stock prices, say what's going to happen if I change my stock price by 1, and see if you can get the right answers. And it will help you to understand how these variables change with changes in these different factors. And that's going to make things a whole lot easier for you, not only for understanding option pricing, but for understanding strategies, which strategy to pick, and how those risks are going to change, mostly as the stock price and time change. So if you know your Greeks, you're going to be one step closer to the art and science of options trading.